Morning, everyone. Welcome to our educational webinar from our great partner, SafeBridge Lending out of Toronto, Ontario, Canada. SafeBridge is going to provide us with some really awesome information about how we can work together as partners, members of the network, and SafeBridge to help your clients with some successful lending options, answer your questions, and definitely if anyone wants any follow-up one-on-ones after this call, we're happy to connect you with our SafeBridge partners as well. So I'm pleased to introduce you to Elisseos Iriotakis. He is the managing partner with SafeBridge Wealth Management and a wealth of knowledge, obviously, that he's bringing to us today. So if you have any questions during the call, feel free to type in the chat, raise your hand, and we'll work our way through those questions as they come up. It's all yours, Elisseos.
All right. Well, thank you so much, Pam and Jackie, for having us on board here, and look forward to presenting what kind of work we do. Hopefully, there's something that we can connect, and if nothing else, just provide some education. And if there's any questions, we'll be obviously more than happy to answer them. We have prepared a fairly short presentation, and I'm going to start with that as we in a second. But feel free to ask any questions as we go along. So just give me a second to start this, and away we go. Okay, can everyone see my screen now?
Yes.
Okay, wonderful. So we figured that since this is a Canada-wide presentation, we do something a little bit different in kind of navigating through the complicated markets that many of us have faced in the last 12 to 24 months, and what's on the horizon, and hopefully, figure out some solutions to when the big banks say no, there's other solutions that we can provide. Let it be on high-end luxury real estate or in the commercial space that we specialize in. Is there a lag? Why is that going on? It's working a second ago. Give me 1 second. There we go. So just a brief intro into who we are and what we do. SafeBridge Private Wealth Lending is a division of SafeBridge Financial Group. SafeBridge Financial Group comprises of a large mortgage brokerage, an insurance provider, and also private wealth. We figured that we'd concentrate on the higher end market to kind of mimic the luxury brand that you guys are associated with. But as a background, we really advise on a strategic credit advisory. Strategic credit advisory is really what we do. And unlike traditional brokers, we focus on more complicated solutions. We concentrate on the high net worth because we all know that they have multiple properties, corporations. They're looking for complicated commercial transactions as they graduate from the residential field. And then we also incorporate some of the institutional and private capital that we have access to through our private wealth. We've been around for over 20 years now. We opened our doors in 2000 and 2004. So my business partner, Chris Karam, and I were the founding partners. Now we're over 75 individuals that operate within the walls. We've funded over $10 billion, and on a yearly basis now we're funding over $1 billion per year. So that number will continue to grow. And we've helped over 15,000 families along the way. And national presence right across the board from St. John's, Newfoundland, all the way to Victoria, BC. So why does this matter? We looked at it and said, what are the challenges that we're facing today? If we go back 3 or 4 years ago, there were obviously lower rates in the market. Everyone's coming up for renewals, so their monthly payments are going up. So higher interest rates have obviously had an impact in the renewals in the last 12 months, I'd say. And for those renewing in 2026 and 2027, we're going to see the similar effect. Are we in a period of rising interest rates? We're not quite sure. We'll see what happens in the next 60 to 90 days with the Iranian war and also with the negotiations of Kuzma. It'd be interesting to see where we land by the end of the summer. Tighter bank underwriting, we'll touch upon that in a few examples shortly. Self-employed income is being scrutinized more and more now. The introduction of FinTrack into the mortgage brokerage space is playing some weird games in there. So you have to really be able to navigate and understand self-employed income, let it be incorporated, family trusts, or just simply a sole proprietor. So navigating those and knowing which lender favors one versus the other is super important. Like I mentioned, the corporate ownership structures play a big role. And, do you have multiple partners? Do you have one partner? That plays a big role as to which lender will entertain the file. In addition, rising commercial lending complexity is something that we are witnessing quite extensively with the condo prices, especially in the Toronto and Vancouver area, dropping. Builders are having a challenging time in finding resources to expand and develop their product. So we've got other solutions that we look at, and we can talk about that a bit in the presentation. Luxury buyers with significant wealth are also finding a little bit of they're struggling a little bit, even though they have high net worth. Banks are kind of not viewing their income in the overall transaction, so we need special underwriting capabilities on that. So understanding that most, if not all, on the call are realtors, this is what the reality is today. Client has significant assets but won't qualify. We've been hearing that from our partners. Business owners show low personal income. In other words, they maintain a lot of it inside their corporation. Multiple rental properties, we're seeing this more and more as they're trying to refinance the rental properties to buy additional properties or consolidate some building up of debt. Bridge financing and timing issues, because properties aren't selling on time, has become something that we've really witnessed in the last 12 months. As well as commercial financing, it just takes too long. Everyone's asking for 60 and 90-day approvals. If you factor in the CMHC, it could be even longer. There were wait times over the last couple of years that were up to 6 months. And it tends to happen whenever CMHC adjusts their policies. You see like an influx of the files coming in. It takes the underwriters that much longer at CMHC to make decisions, and we get the bottlenecks that we see, but there's always solutions to kind of work around it. We have seen an increase in bank declines for more than one reason, and I'll get into a couple of examples that hopefully highlight that. And then, cross-border buyers don't fit traditional lending. Obviously, there's been some restrictions in Canada, and hopefully they open up in 2027. So the 5 most common deal killers that we've seen is income. So client earns $500,000 through a corporation, but only pays himself or herself $80,000. In a traditional underwriting, you're likely going to qualify for around 4 to 5 times the reported income to the CRA on a personal basis. So an $80,000 income is likely going to qualify for $320,000 to $400,000. Whereas we've got other lenders that look at it either through net worth or self-employed programs that will use a portion of the 500, and many of them would probably use up to 300,000 or 400,000 of that, which allows them to buy substantially more. Too many existing properties, that's a real big one. The majority of lenders are going to allow you 1 principal residence and 4 residential rental properties. Some of them will expand to number of doors. So if you've got the limit tends to be between 12 and 15 doors. So if someone has 4 fourplexes, they get to that limit very quickly. So those professional investors are running into challenges, and that's where we step up and find an alternative investment or analyze the portfolio and take them to private banking. And they've got some unique programs. Timing problems, purchases before closes before the sale, and then the sale falls apart. That's the major issue that we're running into. And then what happens and how do you navigate that? Development and construction, I touched on it just a little bit earlier. Land deals are just not getting done. Developers are reaching out to us and looking for access to more funds in order to shore up projects and hopefully be able to go to market in the next, they're saying that 2027, late 27, early 28 is when everything's going to open up, but they got to shore up their properties for the next year or two. All right, so there's different, and the last one, commercial underwriting, there's different rules from major banks to alternative lenders. and the CMHC programs that I touched upon. So here's a typical case study that we see in the luxury side. So a successful entrepreneur in this situation, net worth over $8 million. However, they report that low income of $200,000 personally, so they can avoid, I guess, paying the CRA at the higher tax bracket. But as we discussed earlier, that 200,000 is only going to qualify him for roughly 4 to 5 times, which would take it to an 800 to a $1 million purchase. This buyer in specific only wanted to put 20% down. That kind of makes sense because they don't want to take money out of the corporation and pay additional tax on that, on the dividends or salary, depending on how their account structures it. So they only wanted to put $800,000. So they were looking for a $3.2 million mortgage. Most banks will decline this. However, the alternative lenders that we do work with, and this part of the SPW lending strategy, will allow us to analyze the corporate income, look at the alternative, and in many cases will allow us to look at 6 to 12 months of bank statements, do an analysis there, and allow us to use substantially more income in order to get us to the 3.2, being $3.2 million. Some lenders will also allow us to consider the net worth. And this is where we find a lot of the bottlenecks. Not every lender is made the same. What National Bank will do is different than what Scotiabank will do, is different than what RBC will do. And that's our responsibility. When we do talk to the client early enough, we're able to navigate it based on their existing situation. So we were able to navigate this situation, and the individual was able to purchase this $4 million property with an 800,000 as a down payment and a $3.2 million mortgage. Are there any questions up until here? Okay. So understanding today's lending landscape. So we got the traditional banks that will do a lot of the cookie cutter deals that are out there. They love the salaried individuals. They love those that pay taxes through dividends and capital gains and whatever's reported on their T1 generals and notice of assessments. Once you step outside of that, even though they tell you they like doctors, lawyers, professionals, it gets a little hairy. And again, it comes down to the lender. Credit unions, on the other hand, are not regulated federally. So it's a provincial regulator. So every province will have slightly different credit union rules. But overall, we kind of summarize it that these are the things that they really have flexibility with, a little bit more flexibility on their underwriting. Many of the credit unions are really good at construction financing, and there's a different one in every province that we prefer. And then business owners with more complicated income, we've discussed that a little bit. So those are the two traditional type of lenders that you see on the street. But once you step outside of that box, this usually allows you to have a client pre-approved for a much higher purchase with flexibility and minimizing the tax that they pay. And that's where the alternative lenders come in. Alternative lenders could be CMLS, First National, Equitable Bank. You've heard of them. They're all banks, or sorry, not all of them, but the majority of them will be banks. But they do have alternative products, especially as you get closer into 35% as a down payment. Some of them have that flexibility to 80, but not everyone does. And then, of course, private capital. We have I don't know, probably $250 million at any given time ready to go and to be deployed for private financing. And many of the high net worth individuals are comfortable in paying a higher interest rate in order to shore up a property, because there's always a rush. There's transitional financing. They got to sell a building inside the corporation, but they want to buy that luxury real estate today because there's a deal. We're starting to see that because the luxury market has had some drop in value in pricing. So now we're starting to see these entrepreneurs stepping up and saying, I want to buy that, but I haven't paid enough in my taxes. How do I formulate that solution? So these are the 4 different type of lenders that we kind of work with. So back to the beginning of the presentation, when banks say no, SW loves to say yes. All right, and here are very quickly the examples of the borrowers that we enjoy working with. All right, so here's another scenario, investor financing opportunities. So this situation, actually, it wasn't an example. So more or less, this is a real estate investor that's looking to grow their portfolio. And what I wanted to do in this slide was differentiate between some of the big banks and the lenders that are still considered A lenders or A minus lenders with a slightly higher interest rate, but one versus the other. And if it all start, a lot of it starts with the debt coverage ratio. So if you're working in this space, you start to realize, well, the debt coverage ratio is really, how much debt can you afford in comparison to the rent that you are receiving, minus all the expenses that are associated. So some of the bigger banks, like the RBCs of the world, the CIBCs of the world, want to have a 1.2 to 1.25% debt coverage ratio. So if you have $1,000 in rent, they want to see that your payment can afford the other way around. So if you have if your mortgage payment is 1,000, they want to make sure that there's enough revenue of 1,250 or 1,200. So there's a whole formula that goes through it, a lot of calculations. But what we try to figure out is if we can squeeze them under the 1.2, which simply means that they're putting a large amount of down payment. So usually in today's world, you're looking at 35 to 50% as a down payment in order to qualify for the 1.2 times DCR. Whereas if we can get it away with the break-even point of 1 to 1, then we can find situations and properties that are between 75 and 65% leverage. So in other words, you're only putting 25 to 35% down. So there's a lot of deals that can be squeezed out of that. Rental qualifying issues. I mean, if you've been in long enough, some lenders will use 50% of the rent. Other ones will use 90, 95% on the other extreme. So we need to understand what appetite the lender has and then kind of marry it with the client situation. Portfolio concentration. Many lenders, after a number of doors, especially those 4 or 5 doors that we were talking about, or 4 or 5 properties, will not entertain anymore. And so there's certain restrictions. Some of them only allow 4. The other ones will go up to 15 doors that I mentioned. And then you start getting into commercial and private banking, and that's a whole different ball of wax. So how do we find solutions for this? We portfolio lending. I'll give you an example of that just in a second. Equity extraction. So what do we do is we go back to the portfolio, we stretch out the amortization to bring down the monthly carrying costs, and that gives us the opportunity to take more money out for the clients to fulfill their next project. So those are part of our refinancing strategies. Okay, so commercial real estate in 2026, we'll just divert a little bit into this. What is working right now? So multi-family, which is purpose-built rentals. Some of you have heard of the CMHC programs and the MLI Select. Those are extremely popular right now because builders are not building for resale in condos. However, they are looking at rental for sustainable projects, and the government's kind of backing this as well, as we've seen. And industrial is a huge one as well. With a big push in data centers, especially in the U.S., you've seen a lot of data centers popping up in warm parts of the world, and in northern Alberta, we've seen some of those popping up there because of the cooling scenarios, and some the extra sun that you do get during different times of the year. So we're starting to see a high demand for both of those asset classes. You could probably guess that offices aren't as popular as they once were, and prior to COVID, everybody was working downtown. The office spaces were full. Now, with some work coming back to work, it is improving, but it's nowhere near what it should be. Retail, that's been slapped across the face quite extensively. unfortunately, and land development. We're finding that lenders are just backing away from land because it's very difficult. What is it going to be worth in 12 months? So, there's solutions there, and again, every lender is slightly different. Some of them are just said no outright. They don't want to touch any land for the next 12 months. And other ones will leverage up to 50% as long as you have a sustainable project that you're kind of driving towards. And the scenario I ran into last night was, there was McDonald's as one of the anchor tenants, had a letter of intent. It gave us obviously that hope that this project will get to the finish line. So the lender was willing to go up to 60% of the land value. So there are solutions, but obviously it depends on the anchor tenants. So the commercial case study. So here, this was something that someone walked into us last year and was looking at buying a $32 million property, and was looking for solutions outside of, in this case, it was CIBC, outside of what CIBC was offering, because they wanted them to put at least 25% down, if not 30. And we were able to kind of traditionally walk away from the bank and go into that CMHC insured financing that I had touched upon, specifically the MLI Select program. And that's a whole presentation in itself if you've never worked in it. But what it really does is it gives you the opportunity to extend your amortization, work with a lower DCR, and also you can get away with as little as 5% if you can believe it. Most projects don't work with 5%, but at 15% down, you can make most numbers work when you have that extended amortization and a lower DCR. So that was a solution for this case. Client was happy. They only put 15% down and were able to walk away with the loan that they wanted with an extended amortization. The other thing that you do get with CMHC insured, especially on the commercial front, there is a lower interest rates than what you would get traditionally at a bank. So not only are the big banks giving less money, they want their portfolio to be more secure, which is obviously the lower DCR, and they're also charging a higher rate. Whereas the CMHC program, in effect, is guaranteed by the Canadian government and of course us taxpayers. So they allow a little bit more flexibility there, because I hope the Canadian government never goes under, but that's really the reason. It's guaranteed by the Canadian government. Okay, so why realtor partnerships matter to us. So when we try to educate our realtors early on, because I think it does help them, and it definitely helps us as well. If we are engaged early on into the process, we obviously have a better client profile. We're able to understand the situation, and then we're able to educate the realtor and the client at the same time. So no one's really wasting any time. There's always going to be a financing surprise. The question is, can we minimize those surprises by understanding the client's situation? Right. And then when we do have a good understanding of the situation, obviously there's faster solutions, quicker turnaround times, and it gives us a broader base of lenders that we can work with. And just kind of slowly wrap up, SafeBridge does look at things beyond just the mortgage. We are a full suite of financial integrity, I want to say. Most firms will obviously stop with the financing when you're talking to a traditional broker, but we do expand that. We have the abilities and the staff to handle it. So it's not only lending, it's wealth planning. Insurance plays a huge role when you're dealing with the luxury client and luxury real estate, along with the tax planning. We find that those two go hand in hand in enhancing a client's net worth, minimizing the amount of tax they paid today, but also when they pass away, and then also accomplishing that final piece where, getting a better mortgage or a larger mortgage to satisfy their complicated tax situation. So that's kind of us in a nutshell. And in summary, I guess current opportunities that we are seeing with realtors, and maybe something to watch out for. If there's jumbo mortgages, not all banks are made the same. Corporate borrowing structures, we're very familiar with them. We have accountants on staff. and lawyers ready to go. So understanding the corporate structure, let it be family trusts or multiple holding companies or multiple operating companies. That's please engage us in that. We're very good at that. We're tax experts as well. Investors who want to grow their portfolios and take advantage of the existing market. Prices have come down, so there are some opportunities that are popping up. So we can help restructure their existing portfolio, take it to private banking if it makes sense. We just ran through one a couple of weeks ago. Individual had 26 properties in a holdco and another 18 personally. No lender would touch that. And we were able to refinance the entire portfolio inside the corporation, take it private banking, educate them as to what needed to be done. They were totally on board, and we were able to free up an additional $2.5 million. So that gave them the leverage to buy 2 additional properties, but also tax plan, which is going to save them, I can say, $10 to $15 million by the time the estate settles when they pass away. And then commercial, like I mentioned earlier, the apartments, industrials are huge, huge opportunities and some signs of development, but it's got to be for the right structure.
Elisseos, do you see the question in the chat?
I just saw it.
How much more is the interest rate versus traditional interest rates is the question.
Yeah, no, good question. Please understand that if we can build a case to take them to the traditional banks like Scotiabank, TD, RBC, we will take them there first and foremost. So it really comes down to the client situation. The rate is always one piece of the pie. Like, RBC may give you a 5% commercial rate or 5.25%, but they may only give you half the amount that you need in order to buy that property. So that's really what we're trying to navigate. And then, going to CMHC, we're getting rates below 4% today with a longer amortization, which allows the clients to buy more. So it's not always a higher rate when we're dealing with this. I really have to emphasize that. It's really finding a situation, building up the proper product for the individual and their situation. And in some cases, it's going to be a little bit of a higher rate, depending on the alternatives. If it's like residential is different than commercial. So I'll touch upon that, like as a very simple example. Residentially, most banks right now are hovering between 4.25% and 4.5% when you're looking at their fixed rates. The alternatives are 4.89 to 5.25%. So there's not a huge difference. So I'm going to call it, you're paying an extra 1%, but that also means that you're not taking out 40% tax money out of your corporation to make this happen. So self-employed buyers need to understand that they're saving in tax a lot more than that 1% that they're paying extra in interest. And that's just one simple example. Hopefully that answers the question. Okay, so some triggers for you as you're talking to clients and are posted here. Are they self-employed? Do they own properties? It's kind of all summarized in those a little bit more situations that are just not salaried employees. I think that's really what it comes into. We'd love to do the salaried employees. Those are the easy ones. So with every complicated one, we welcome the salaried employees, because that's when it becomes a rate game. And doing well over $1 billion a year, we're top of the class with the majority of those lenders. So and that's it. So please let me know if there's anything else any questions that you may have at this point. We'd love to open up the floor to the team, and let's go from there.